It is Tuesday, March 15th. It's the Ides of March, so beware. Today I want to look at moving averages and just different ways to look at averages. I know there's many different types, from simple, exponential, adaptive, and other sorts of variable averages that move with the market. But I want to look at something very simple. Here we have a chart of Amazon and a simple 200-day moving average. Nothing fancy, everyone knows about it. But a lot of people looking at averages as trend change indicators. And although I don't think averages should be used quite like that, I don't think they're that specific when in terms of telling you when a trend actually changes. But if you look at Amazon, you say, okay, it looks pretty good here on this closed chart. It didn't close below the average over here. It kind of closed below the average there. So did you get a false signal? And here it breaks through. That's good. And now, kind of back up and fails. Kind of back up and fails, and finally breaks out on news. So the question is, is this any good? Can we make this any better, but keeping it really simple? So check this out. I'm going to turn this, instead of an average of the closes, I'm going to turn this into an average of the highs. And then I'm going to add another moving average. Oops. 200-day average of the lows. Now you have sort of an envelope here. It's not what you'd officially call a moving average envelope, because it's not a high and a low spread off of a central average like a Bollinger Band, things like that. It's just an average of the highs and an average of the lows. And it makes a tight channel. Now look what happens back here. Here, early 2013, stock is trending, but kind of flat in an overall trend. It does not move below, does not close below the average of the lows. So you get a little better signal there. And here's definitely a whipsaw, but at this point the stock is not trending anymore. It's kind of flat, so you get whipsaws. Same thing, you're getting whipsaw around here. But let's move back in time. And you can see it doesn't make it perfect, but it makes it better, which is kind of all you could really ask. Okay, let's change stocks. I'm going to put up Facebook, and I'm choosing these so-called FANG stocks for a reason, just because they have momentum and they are trending. You don't want to use averages too much in a flat market. But here's the highs and the lows, and you can see over here in 2015 you have some good examples. Let's zoom in a little bit, and you can see it's within the band here, but didn't close below the low, which tells us to stay long. So staying long over here, well, it's kind of nervy. Maybe you would have gotten out a lot higher, but if you were looking to trade, possibly gotten back in for whatever reason. I'm not saying the average is telling you to get back in. It's whatever other system you're using tells you. So I like it because it just gives you a little bit of extra information, makes it a little bit easier to spot things that are changing. Here's another example. Let's zoom in over here. It closed below the closing average, but not below the low average. So possibly a good value area to buy Facebook. If you had other reasons, I'm not saying just the averages, but to have other reasons, it kind of adds to your case. All right, now I want to get to the current market. Let's take a look at the S&P 500. Zoom out again. There are a few examples where it works better, but not great. It works better here, keeping you short if you were short already. Here again, it doesn't give you that false breakout sign that a 200-day closing average might. And again, you have a definitive sign here. There's other things that could be happening. You have possibility of drawing these trend lines here, and you can see that you combine the trend line with the average, and you knew not to buy here. Here, a much better time to buy. And moving closer to the future, again, not perfect. But now the big thing, something that I've been looking at, is that the market is kind of in this rounded type of topping pattern. Nothing really scientific here. And using the 200-day moving average as kind of the the line in the sand, not your trade trigger. Again, I don't think averages are trade triggers, but I think it's just a place where you say, you know, if it gets through here, I might have to reconsider what I'm thinking. So if you look at the closing average, and I'm going to add the closing average now just so we know what we're talking about. Moving average, 200-day close. So you can see it did move above that average this week, or should I say on Friday of last week. That might have been a false signal to go long, and you can see what's happened over the last 2 days. So I'm using the average of the high up here as kind of a better signal. Now let's think about why the high would be better. Well, you have the ebb and flow, you know, ups and downs of a trend, highs and lows. You would want it to break through the top of the trend, which would be the highs. So it's just a simple little logic, and I think you get a better signal. Again, not perfect. You want to use this with other things, and certainly do not want to use it in a flat market like you had back here. But just something else, another trick to use, and possibly give you some better decisions.